This week on Wealth Track, part 2 of Wealth Track's exclusive interview with two of the world's most influential investors. PIMCO's great investor Bill Gross and financial thought leader Mohamed El-Erian sit down together to discuss their investment strategies in the new normal. Next on Consuelo Mack, Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. If you're interested, just go to wealthtrack.com for more information. Thank you. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. This week we are continuing our exclusive conversation with PIMCO's two influential financial thought leaders, Bill Gross and Mohamed El-Erian, together. It is a rare occasion to be able to interview them side by side. And as you will see, they are a fascinating study in how a successful partnership works. Since 2008, they have been co-chief investment officers of one of the world's leading money management firms, Pacific Investment Management Company, PIMCO, which Gross co-founded in 1971. El-Erian is also CEO and is expanding the firm from its very large bond roots into stocks, commodities, ETFs, and passive, as well as its core active strategies. Gross's legendary PIMCO Total Return Fund, which he has led to the top of the bond world in performance and size since 1987, will soon have an ETF clone actively managed by him. El-Erian, a former head of Harvard's endowment and 15-year veteran of the IMF, was also a top-ranked emerging markets bond fund manager during his early years at PIMCO. He now co-manages the PIMCO Global Multi-Asset Fund, which, as its name implies, can invest anywhere in the world in multiple assets through passive indexes and actively managed PIMCO funds. According to Morningstar, it is the first PIMCO fund to be formally run in a team format, and it also has an innovative tail risk hedging strategy to cushion it in down markets. It could be a model for the firm itself. El-Erian and Gross are hedging their bets in all sorts of ways. They are working overtime to understand what El-Erian calls the string of once unthinkable macro events of recent years, which he and Gross believe are having a huge negative impact on the markets and investment results. They are also preparing for an even weaker, new normal, slow growth and low return environment than they envisioned for the developed world back in 2009. We pick up the conversation discussing this year's uncharacteristic underperformance of Gross's PIMCO Total Return Fund. I asked Gross if this time feels different than the few other years when the fund fell behind.
Well, the underperformance has been more substantial. Let's be honest about it, and so it feels different. The problem this year is that the Total Return Fund for the first 6 to 7 months was set up for a new normal type of economy, and now we're in the new normal minus. And so the shift, which propelled Treasury prices higher and Treasury yields lower, was actually very quick and very sudden. It was related to some extent to the debt ceiling crisis, which occurred a few months ago, and the lack of confidence in the United States. Surprisingly, when it was downgraded to AA+, Treasury did the best, and that was because of the recognition on the part of investors that the ability to address the deficit, that the ability to basically produce growth going forward was limited, as opposed to new normalish.
Right.
And that was the big problem, I think, that the Total Return Fund had in terms of adjusting so quickly.
So you've rebalanced, as Mohamed said in a recent interview, the Total Return Fund. So the last I looked, you had 16% in Treasuries. Given what you just told me about the new normal minus, are you increasing your Treasury exposure? I mean, what are you overweighting now in the total return fund?
We're overweighting mortgages. Mortgages are agency guaranteed, quote unquote, not an explicit guarantee, but an implicit guarantee that becomes more and more explicit as the years and the verbal guarantees.
So like Fannie and Freddie?
Fannie and Freddie. Those are mortgages which yield 3 to 3.5%. Sounds very low, but compared to a 5-year Treasury at 1.25%, that's a nice, attractive spread. And so mortgages have been overweighted. They're not Treasuries, but they're Treasury related. They're, in our opinion, very safe AA plus, AAA type of assets, and that's one area where we're hoping to pick up yield without sacrificing quality.
So the other stuff like financial services bonds, like Citigroup bonds, or some of the emerging market bonds. So are those things that you are now underweighting? So have you done a risk off trade, pretty much in the total return fund, or
no? The risk off has basically been evidenced by increasing the Treasury overweighting as a counterbalance to the risk. We haven't really sold our J.P. Morgan or our Wells Fargo assets in terms of the financially related credits, nor have we sold the emerging market countries. We're a believer in emerging market growth, but we've certainly tried to counterbalance that with a higher concentration of Treasuries, and I think that's working out fine.
Mohammed, I have to ask you, When Markets Collide, which was your best-selling and really wonderful book that came out several years ago, which was, again, very prescient. And one of the things that you talked about on Wealth Track with me a couple of years ago after that book came out was that one of the lessons that you've learned from the financial crisis is that the unthinkable can happen. So when I just hear, Bill describing the fact that Treasuries rally after the debt is downgraded of the U.S. So what are the other big unthinkable things that are happening that are affecting PIMCO's investment outlook and strategy?
I used to keep a list of unthinkables, but it got so long that now I keep it to the last 3 months. Okay, just think what has happened over the last 3 months. We've had, as Bill said, the U.S. government flirt with default on the biggest bond market in the world. Unthinkable. We've lost our AAA from one rating agency. Unthinkable. We have now 3 European countries in the elite club, the Eurozone, rated as junk. One is rated worse than Pakistan. Unthinkable. We have Switzerland that has made its name as the safe haven take steps to stop being a safe haven. They said we don't want to be a safe haven anymore, right? All these are unthinkables. If we were having this interview a year ago and I said, in a year's time, this is what would have happened, I would have doubted myself on every single one of them. I would have doubted myself even more on all of them. And yet they've happened. Why? The system is trying to tell us something. What the system is trying to tell us is that there are major global realignments. I tell my wife, it's like the tectonic plates shifting. Okay, you get lots of earthquakes and things realign. And we're going through a major realignment. And it's happening slowly.
It is? Feels awfully fast to me.
Well, let me take the example. So let's take the example of Treasuries. This is a situation where PIMCO was right on 3 on the 4 issues that are critical to the valuation of Treasuries. But the 4th one became so large. So Treasuries are determined by the outlook for growth. If you remember, consensus was up here, we were down here. Consensus came towards here. Treasuries are dictated by the outlook for policies. And we've been saying for a long time, don't expect the Fed to raise rates. It is floored at 0 for a long time. That has happened. Treasuries are also determined by the credit outlook. And we've been expressing concern about the credit outlook. And sure enough, the US lost its AAA. But there was that 4th element, which is the flight to quality. So PIMCO's view was, why not gain what Treasuries give you in AAA countries instead? Why not go to Norway? Why not go to Germany? Why not go to Australia? Why not go to Canada, where you can get the same interest rate exposure without credit? And what happened because of all these unthinkables is suddenly the flight to quality became dominant. People didn't care anymore. Bill has this notion of your cleanest dirty shirt, that people are willing to wear their dirty shirt if they view it as the cleanest dirty shirt. And
So the U.S. Treasuries are the cleanest dirty shirt.
Are the cleanest dirty shirt, right? And that is a little bit of driver of the unthinkable. For us, it's been an important reminder to push ourselves even harder in terms of thinking of what else can happen out there. And I think that is the challenge for everybody. We're navigating these major changes. The markets are going to romance very short-term things. That's how else do you explain to someone that in the last 50 minutes of trading, the Dow can move by 400 points on a policy headline?
Try high-frequency trading.
Well,
Up to 70% of U.S. market volume now.
And
that's not policy. That's technological reality in the markets.
Correct, but lack of conviction, right? So when you don't have the conviction, when you don't have the anchors, all it takes is you tip it a little bit, and then everybody takes you one way, and then suddenly you tip it the other way, and everybody else takes it the other way, because we've lost our anchors. We've lost the conviction because the US is going through the unthinkables and Europe is going through the unthinkable. And that is the world that all investors have to navigate through, and it's an uncomfortable world. It takes you out of your comfort zone, but you have no choice. That's the reality of today's world.
So, do fundamentals still count, Bill?
Well, they do, but fundamentals are being distorted in the financial markets and have been for 10 or 20 years, but even more so now. Fundamentally, you could say that with inflation at 2.5% to 3%, that a 10-year Treasury deserves to be at 3.5% to 4%. That would be the historical relation. Fundamentally, you could say that the policy rate at Ben Bernanke's Fed fund level should be at 2 to 2.5%. That would be the historical relation to inflation. But fundamentals have been thrown out the door, certainly because the economy hasn't recovered, unemployment's at 9%, et cetera. The Fed must do something. But also the series of quantitative easings, the 1, the 2, the twist, have produced distortions in the market that are not really relative to historical example or historical fundamentals. So it becomes a question not just of diagnosing value. We'd be the first to say that treasuries are overvalued relative to what they're offering the investor class. But in addition, you have to observe where they're going to be from the standpoint of policy technicals. Will the Fed stay at 25 basis points for the next 5 years? And if so, then it's certainly to an investor's advantage, instead of accepting 25 basis points for successive periods of time for the next 5 years, to buy a 5-year Treasury at 1.25%. And so it becomes a question not just of fundamentals, but of determining policymaker choices and policymaker decisions going forward, and that's a delicate balance.
What do you say to individual investors now who have been basically grown up thinking that they should be in the stock and the bond markets for their retirement savings, and that's what we should depend on? Can they depend on it?
So we tell them it's right to feel unsettled, right?
Yeah.
Because again, we are going through major structural change.
Right.
Right. And there's these shifts, and you're going to feel uncomfortable. It's like someone in the middle of an earthquake. They're going to feel uncomfortable. But the answer is not necessarily abandon the city, but rather understand what's going on and understand what is fragile and where there is value. Because if you understand and have the right mindset, you can navigate. We did something, luckily, on the business side that has helped us a lot, which is back in 08, 09. We invited a professor from the London Business School to come and speak to us. And he made his reputation, his name is Don Sull, by looking at why successful companies split into either remaining successful or not. And it's really interesting. It's not because they don't recognize the paradigm shift. Companies are very good at recognizing when the world is changing. It's what do they do next? And the biggest trap that a company can fall in, a biggest trap that an investor can fall in, is that they recognize the shift, but then they become hostage to what's called active inertia. Active inertia is active in the sense that you do something, but inertia, you're doing more of the same. But your world is changing, and therefore you have to evolve with it. And therefore, the message that we tell investors is you're right to feel unsettled. Okay, that's because the world is changing, but understand that requires you to also evolve with it.
So
right?
Tell us, how do we adapt as investors? And I know one of your specialties is emerging markets. You were one of the top emerging market, ran one of the top emerging market bond funds here for 7 years. How do we adapt? What should we be doing with our portfolios?
I'll tell you what we did at PIMCO. First, we make sure we have the best sector and country specialists. So you want to have the best people there that are looking at the world from a bottom-up perspective. But that's not enough. You need to complement it with a top-down. You need to ask them every single day, are your choices and what you like and not like consistent with the growth dynamics that we're seeing? Are they consistent with balance sheet? Balance sheet is absolutely critical to navigate an earthquake. Are they consistent with the policy choices that the policymakers are making right now? So what we try to do is bring the best bottom-up expertise complemented with a lot of thinking. Bill and I sit through 4 days a week, 3 hours of an investment committee, right? Where we discuss these things over and over again to try and get it right. And it's hard work, but there is no alternative, right?
Well, PIMCO's also diversifying into other asset classes, into equities, and you're doing ETFs. Total Return Fund is going to have a new ETF, which is a whole other topic. But back to the original question is, how do we as investors, I know how PIMCO's adapting, but how do we as investors adapt our portfolio? What should we be doing differently?
So first, be very clear about what your objectives are. Second, be very clear what your risk tolerance is. Third, recognize that the answer today to your objectives are solutions, not products. Investors make the mistake of thinking only in product space, but you need a more holistic solution. Fourth, be very clear as to how much volatility you're willing to stomach, because volatility has this nasty tendency of encouraging you to do something stupid at the wrong time, right? And then you can put together a portfolio. It will mean being more global than you are today, much more global, right? It will mean understanding that the asset classes are transforming. For example, the S&P today relies to a great extent on what's happening overseas. It's no longer
right,
domestic.
40% of revenues are overseas, right?
Correct. And thirdly, don't be hostage to the familiar. So we have a tendency of saying, I'm only going to invest in this name because I've seen it. Well, you know what? There are certain names, as Bill mentioned, that are coming up in the rest of the world that are as attractive, and they are the big names of tomorrow. And therefore, it's important to target tomorrow as opposed to yesterday.
So, Bill, same question to you. So, how do we adapt to the new reality as investors? How should we be positioning our portfolios?
As Mohamed's suggesting, you need to go global. You need to think to some extent in non-dollar space. The world revolves around the dollar. The dollar is the reserve currency, but to the extent that it depreciates relative to other currencies and relative to stronger growth economies over time, then other economies and other assets that are in non-dollar space might be a significant advantage. It doesn't mean, take your entire portfolio and put it into Brazil and into the Brazilian real, but it means an investor probably, if they want a higher return, they're going to have to go to those parts of the world and those currencies which offer a higher rate of return. So I think that would be critical. And last, as Mohamed has suggested, you simply have to know what your risk parameter is. We're fond of quoting a phrase from Will Rogers that says at certain periods of time you should be more concerned about the return of your money as opposed to the return on your money. We try and do both here. But importantly, during a period of uncertainty, during a period of slow growth in the developed world or no growth in the developed world, certainly the return of your money is critical going forward. You don't want to lose 10 or 20% of it because you're behind the eight ball going forward.
So Mohamed, specifically, you co-manage PIMCO's Global Multi-Asset Fund, a fund of funds. So how are you positioning it? What are you overweighting in the PIMCO's Global Multi-Asset Fund?
So importantly, this is a go-anywhere fund.
Yes.
It can do equities, it can do commodities, it can do fixed income, all in the liquid space. And even more critically, it's a fund that has tail hedging in it. Now, tail hedging is something that's very familiar to people as individuals, but not as investors.
So explain what it is.
So when we buy car insurance, we tail hedge. We ask the question, what deductible do you want? 500, 1,000, 2,000. Now, we don't buy car insurance because we think we're going to crash the car. Because if you're going to crash the car, you shouldn't be driving. We buy car insurance because there's a small probability of a really bad event, and we want to know whether we can limit our losses in that world. So the global multi-asset strategies, what they do is they incorporate within the construction of the portfolios this tail hedging. And you see how it's worked during the third quarter, which was a terrible quarter. And it really does kick in to limit the downside in that. How are we positioned relative to most people? We're much more global. Secondly, we look for equity risk, but very high up the capital structure. What investors,
So senior credit, for instance, I mean preferreds.
so senior credits. So what a lot of investors sort of don't think about, they think of equities as equity risk only coming in equity. If you buy commodities, you'll be amazed how much equity risk there is in commodities, because commodities are also correlated to growth, just like equities are. So in certain states, commodities can offer you a better claim on the upside than equities do. We are overweight emerging market bonds. We're overweight local bonds in emerging markets, where we think that you are earning both a high interest rate and you have a potential for capital appreciation. We are diversified in currency, as you can suspect, given what Bill just said. And we look at this actively. So there's three of us who run this fund, Veneer Benzali, Curtis Muber, and myself, and we each responsible for a different part of it, but we consult every single day and position it accordingly. What we've been doing recently is we've been increasing our gold exposure. We had taken it down significantly as gold peaked. We thought it had gone too far. Now we see potential. We think that we are still in a very volatile period. We are going to have many bouts of risk off, right? And people are going to look for hedges, and increasingly gold is starting to enter as part of a asset allocation. So we have been increasing gold, and we have been shifting out of the US, which has outperformed in the equity space, to certain emerging economies that were initially hit hard, not by their fundamentals, but by the amount of capital that came out.
Right.
So this is a continuous repositioning to reflect, valuations and also our secular views.
One investment for a long-term diversified portfolio. I ask all of our guests this at the end of Wealth Track interviews. So Bill Gross, what would your one investment, what should we all own some of in a long-term diversified portfolio?
Certainly bonds.
Certainly bonds.
Yes.
Broad category.
Because bonds, high-grade bonds, not necessarily treasuries, but single and AA corporate bonds, provide an acceptable return relative to inflation. Not a historic return, but an acceptable return relative to inflation. And in an uncertain world of slow to no growth in the developed world, it seems to me that investment-grade bonds of multinational corporations, single, AA corporations which yield 3 to 4 to 5% are certainly low, but acceptably high relative to inflation and relative to the alternative. So for a longer-term investment, for a 5, 10, 15-year type of investment, a single A or a AA corporate bond, and for those that are earning a Wall Street as opposed to a Main Street income, municipal bonds in the single and AA category are very attractive as well. They yield more than U.S. Treasuries, which is a historical twist, so to speak. So I'd recommend both of those.
Mohammed, what is your one investment for a long-term diversified portfolio?
So how to supplement Bill without repeating Bill? That's really hard. Anything that has the three characteristics of very strong balance sheet, exposure to emerging market growth, and income. So either dividends, et cetera. So lots of companies meet that criteria. You can think.
So stocks or bonds?
Right. So think of a Microsoft with a 3% plus dividend, exposed to emerging markets, sitting with a ton of cash. Would be an example of a company like that. There's many examples of companies like that. There are countries, sovereigns that have these characteristics. Right?
Such as?
Brazil, right? Sitting with $300 billion of reserves, having good growth prospects on there, and paying you still an interesting carry or interest income, if you like. What Bill referred to in terms of high-quality companies, high-quality municipals, right? So these characteristics one finds in quite a few different places, and you can build a portfolio on that that allows you to sleep at night, gives you income, and also has, because it has so many buffers in terms of the balance sheet, can navigate this enormous volatility.
So Bill Gross, thank you so much for joining us. Mohamed El-Erian, what a treat to have the dynamic duo from PIMCO here on Wealth Track.
Thank you for coming.
Thank you.
Thank you very much.
At the conclusion of every Wealth Track, we give you one suggestion to help you build and protect your wealth over the long term as well. This week's action point, consider the investment themes emphasized by Bill Gross and Mohamed El-Erian. First, think international. That's where the growth is. Second, think quality of business, balance sheet, and credit, whether it's a company or a country. Third, consider emerging markets, in particular for all asset classes, including stocks, bonds, and currencies. Both Bill and Mohamed recommend holding local currency bond funds, not dollar-denominated ones, to protect against future dollar declines. Next week, we're going to delve deeper into emerging markets with two experts, Matthews Asia Fund's Chief Investment Officer Robert Horrocks and Payden Regal's Emerging Markets Bond Fund strategist Kristen Seva. Both are also successful fund managers. Thank you for watching, and make the week ahead a profitable and a productive one.
Now, more than ever, you want to keep your loved ones safe and secure. We've been helping protect families with the gift of financial security for over 164 years. New York Life, the company you keep.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.